With the rise in inflation and the loss in the value of currencies, daily living is becoming harder each day. However, understanding various investment strategies would not only help you mitigate the negatives of an economic downturn, but also assist you in building wealth over time. In this video, we will delve into 8 meticulously crafted portfolio strategies that will help you navigate the complex landscape of investment opportunities. Whether you're a seasoned investor or just beginning to explore the world of investments, comprehending these diverse strategies, from growth and value investing to dividend-focused and index fund portfolios, will equip you with the knowledge to make informed decisions that align with your financial goals. So, let's embark on this journey to unravel the nuances of effective investment portfolio management and empower you on your path to financial freedom. Be sure to check the description below to see a list of the best personal finance books that have helped me achieve financial freedom. Now, let's see the 8 best investment portfolio strategies. 1. 60-40 portfolio. Our first strategy is the timeless 60-40 portfolio, a classic allocation that blends 60% stocks and 40% bonds. Many investors choose this approach and seek a balanced blend of growth potential and risk mitigation. The 60% allocation in stocks provides exposure to the potentially higher returns of equities, allowing your portfolio to capitalize on market upswings. On the other hand, the 40% allocation in bonds serves as a cushion against market volatility, offering stability and consistent income. This strategy proves particularly attractive to those with moderate risk tolerance, aiming to achieve a reasonable level of growth while ensuring a level of capital preservation. 2. Bogleheads 3-Fund Portfolio. Moving on to our second strategy, the Bogleheads 3-Fund Portfolio is rooted in the principles of simplicity and diversification, which revolve around just 3 funds: the Total Stock Market Index Fund, the Total International Stock Index Fund, and the Total Bond Market Fund. Bogle, the founder of Vanguard, emphasized the importance of minimizing fees and tracking the broader market's performance rather than trying to beat it. The Total Stock Market Index Fund offers exposure to the entire domestic equity market, granting you a slice of big and small companies. Complementing this is the Total International Stock Index Fund, which provides access to international markets, tapping into global economies. These 2 equity funds work in tandem to capture global market growth, and they mirror Bogle's philosophy of capturing market returns rather than attempting to outperform them. To balance out the higher volatility of equities, the Total Bond Market Fund steps in. This fund invests in a wide array of bonds, providing stability to your portfolio and acting as a cushion during market downturns. The beauty of this approach lies in its simplicity. By investing in just 3 funds, you achieve broad diversification across domestic and international equities and bonds. As for the ratio of the 3 funds, it really depends on your risk tolerance and age. The younger and more risk-tolerant you are, the more heavily you would be in the stock indices, and vice versa. While the Bogleheads' 3-fund portfolio might lack the excitement of complex trading strategies, its focus on low costs and market-wide returns has gained it a following among long-term passive investors. This strategy is particularly attractive for those who prefer a hands-off approach to investing, minimizing the need for constant monitoring and decision-making. 3. Ray Dalio's AllWeather Portfolio. Transitioning to our third strategy, Ray Dalio's all-weather portfolio investment approach is aptly named as it strives to thrive in all economic climates. The key to its resilience lies in its allocation: 30% in stocks, 40% in long-term bonds, 15% in intermediate bonds, 7.5% in gold, and 7.5% in commodities. The allure of the all-weather portfolio is its careful balance of assets designed to weather various financial storms. The 30% equity allocation captures the growth potential, while the bond components, 40% in long-term bonds and 15% in intermediate bonds, provide stability and income, even during economic downturns. The inclusion of gold, 7.5%, serves as a hedge against currency devaluation and inflation, offering a safe haven in uncertain times. Similarly, the allocation to commodities, 7.5%, bolsters diversification and hedges against supply and demand imbalances. The Dalio all-weather portfolio's approach is a prime example of a tactical portfolio designed to navigate the shifting tides of the market, leveraging assets with low correlation to minimize risk and maximize return potential. This portfolio's composition reflects its belief in a balanced asset combination that responds differently to various economic scenarios. This strategy particularly appeals to those seeking to insulate their investments from extreme market volatility and are willing to adjust their allocations in response to changing economic conditions. As you contemplate adopting the all-weather portfolio, remember to assess your risk tolerance, investment horizon, and financial objectives. 4. Harry Browne's Permanent Portfolio. Moving forward with Harry Browne's Permanent Portfolio, this strategy is crafted to offer both safety and profitability across all economic scenarios. In this portfolio, assets are divided evenly into 4 categories: 25% in stocks, 25% in long-term bonds, 25% in cash or short-term bonds, and 25% in gold. Here, the philosophy revolves around the idea that these allocations provide a balanced response to economic volatility. The stock allocation, 25%, captures growth potential, while the long-term bonds, 25%, act as a buffer against market downturns. Holding 25% in cash or short-term bonds provides liquidity and stability during economic uncertainties. The final 25% allocation to gold serves as a hedge against inflation and currency devaluation. What makes Harry Browne's Permanent Portfolio remarkable is its simplicity and focus on minimizing downside risk. This strategy is best for conservative investors who prioritize capital preservation while aiming for steady, albeit potentially moderate, long-term growth. It's important to understand that the permanent portfolio's performance may differ from traditional allocations due to its unique composition. 5. David Swenson's Yale Model. This brings us to the innovative mind of David Swenson, the Chief Investment Officer of Yale University's endowment, and his distinguished Yale Model. Often hailed for its institutional sophistication, this strategy is designed to diversify across various asset classes and capture long-term growth. The Yale Model is characterized by a comprehensive asset allocation: 20% in domestic stocks, 15% in foreign developed stocks, and 5% in emerging market stocks. This global equity exposure taps into different economies and industries, providing opportunities for growth across the board. To further enhance diversification, Swenson allocates 20% to real estate, REITs, offering exposure to the real estate market's potential for income and appreciation. The model allots 15% to U.S. Treasury bonds to balance the equity risk, which provides stability and income. An additional 15% is dedicated to U.S. Treasury inflation-protected securities, TIPS, safeguarding against inflation's erosive effects on purchasing power. Swenson's strategy also includes 10% for natural resources or commodities, hedging against inflation and supply-demand imbalances. The Yale Model's strength lies in its adaptability and comprehensive approach, seeking to harness the strengths of various asset classes while mitigating risks through diversification. While initially devised for Yale's endowment, this strategy has influenced institutional and individual investors alike, providing a blueprint for a well-structured, diversified portfolio. Adopting the Yale Model requires thoughtful consideration of your investment goals and risk tolerance. Its complexity may appeal to those who are comfortable with actively managing a diversified portfolio and those who see the potential benefits of a more hands-on approach. However, this strategy's success also hinges on its execution and regular review to ensure allocations stay aligned with changing market conditions. 6. Warren Buffett's advice for most investors. Our journey through investment portfolio strategies brings us to the wisdom of none other than Warren Buffett, often regarded as one of the greatest investors of all time. While Buffett's personal and Berkshire Hathaway portfolios are known for their complexity and sophistication, his advice for most investors resonates with a surprisingly simple approach. Buffett recommends that the average investor allocate 90% to the S&P 500 index fund, a widely recognized benchmark of the overall stock market's performance. This choice aligns with Buffett's belief in the long-term growth potential of the American economy and the collective strength of its corporations. The S&P 500 Index Fund provides diversification across various sectors and companies, capturing the market's broad upward trend. Buffett suggests dedicating 10% to short-term government bonds to complement the equity allocation. These bonds provide stability to the portfolio and act as a counterbalance to the potential volatility of the equity market. By holding short-term bonds, investors have the flexibility to reinvest or adjust their bond holdings as interest rates or market conditions change. Buffett's approach underscores the importance of simplicity, long-term thinking, and the recognition that not all investors need complex strategies to achieve financial success. While his personal holdings and investment decisions are far more intricate, his advice for most investors is grounded in the principles of passive investing and capitalizing on the market's inherent growth over time. 7. Paul Merriman's Ultimate Buy and Hold Portfolio. Now, this leads us to the innovative mind of Paul Merriman's Ultimate Buy and Hold Portfolio. This strategy centers on comprehensive diversification across a spectrum of asset classes, aiming to capture long-term growth while managing risk. Merriman's Ultimate Buy and Hold Portfolio is a testament to his belief in the power of diversification. This strategy incorporates a range of asset classes, including U.S. large-cap and small-cap stocks, international large-cap and small-cap stocks, emerging markets, real estate investment trusts, REITs, and bonds. In each of these asset classes, you would theoretically be investing 10% of your money. By diversifying across these asset classes, investors can potentially benefit from various sources of return and risk reduction. Including domestic and international stocks taps into the growth potential of different economies and industries. Emerging markets provide exposure to economies with significant growth prospects. The allocation to REITs offers access to the real estate market's income potential and capital appreciation. Bonds provide stability and income, particularly during market downturns. Merriman's approach is rooted in the philosophy that a well-constructed portfolio should capture the strengths of different asset classes while mitigating the impact of market volatility. The emphasis on diversification seeks to reduce the risk associated with relying heavily on any one sector or market. 8. Bill Schultz's Coffeehouse Portfolio. Our journey through investment portfolio strategies concludes with a visit to the world of simplicity and passive investing with Bill Schultz's Coffeehouse Portfolio. This approach, named after Schultz's analogy of comparing portfolio management to sipping coffee at a cafe, centers on ease of management, long-term growth, and disciplined rebalancing. The Coffeehouse Portfolio showcases a straightforward asset allocation strategy. Roughly 40% of the portfolio is dedicated to bonds, providing stability and income. The remaining 60% is divided evenly across a variety of equity classes. This equity allocation encompasses large-cap and small-cap stocks, international stocks, and real estate investment trusts, REITs. Schultz's philosophy is that investing should be uncomplicated and accessible to all, regardless of their financial expertise. By keeping the portfolio's structure simple and balanced, investors can focus on their long-term objectives without getting caught up in the complexities of market timing or intricate strategies. The Coffeehouse Portfolio emphasizes the power of disciplined rebalancing. Regularly returning the portfolio to its original allocation ensures that winners are trimmed and losers are given an opportunity to recover, ultimately aligning with the adage of buy low, sell high. This approach resonates particularly well with those who prefer a passive investment strategy and don't want to actively monitor their investments. By adhering to a predetermined allocation and periodically rebalancing, investors can maintain a diversified portfolio that aims for steady growth over time. As we conclude our exploration of investment portfolio strategies, it's evident that the investment landscape offers a wide array of approaches, each catering to different philosophies and goals. From growth and value investing to socially responsible and diversified strategies, the choice ultimately rests on your comfort level, risk tolerance, and financial aspirations. Our journey through these strategies has aimed to equip you with valuable insights into the intricacies of portfolio management. Successful investing requires ongoing learning, adaptability, and a clear understanding of your financial situation. No single strategy guarantees success, and the best approach aligns with your circumstances and objectives. If you enjoyed this video, hit the thumbs up to like and let us know your thoughts in the comments down below. Be sure to subscribe, like, and turn on your notifications for more videos like this one. Also, you can check the description below to see a list of the best personal finance books that have helped me achieve financial freedom. Thanks for watching, and see you in the next video.